Hey guys, Mike here. So I wanted to make a quick video about what's going on here in the crypto market, because I've been doing a lot of thinking and also been talking to Scott earlier this morning about this topic, and it's something I want to share. So first thing, of course, right, look at Bitcoin, right? It's at 46,400. So it's great. This looks good. This looks like a typical formation that will resolve higher. There might be a retest. I mean, it's not impossible. Anything's possible in crypto, right? But I mean, look what we've been through, right? Since late May. I mean, it's been brutal, and the consideration is, can this be avoided, right? I mean, it's something where we've been building this system, and the system has kept us out of the worst, right? But we're still, at some time we're 50% down or so, and that's rough, right? I mean, it's really hard to sit through such a deep retracement. By the way, you guys have done great, and everyone was really on the ball, really kept by the script. The majority, there was a few that jumped off, but the majority of people, vast majority actually, really kept in the game and knew exactly what the mission was, and kind of stuck it through. And I'm really proud of you guys. So this is great. But more productively, we're thinking, I had this chat with Scott earlier this morning, what can be done. And so we're talking about a few things. We've done some research that is related to that. And because, of course, it would be great if you could catch every wiggle. And, the problem is with trying to catch every wiggle in doing a bull market, like if there's, interim corrections, can we somehow spot these interim corrections? So you basically, you go in, you write it up, then you get out near the top, and buy the dip again as soon as it presents itself. I mean, this be a week or 2 weeks or a month or two. In this case, 2 months later. Right? And to be honest, it's difficult because trying to catch every wiggle, it's nearly impossible. I mean, I've tried many years. I've built many systems, and look, in 2017. Bitcoin, right, had like 4 mini crashes, and then boom, it bounced right back. So the thinking is that, what we can take away from this is that trying to catch every wiggle is almost impossible. It's really very difficult, and it's really difficult to go, especially time it properly here, right, and write it down, wait it out, or maybe even write it down. In the stock market, you could short, right? And then buy it back again, and then write it back up again, and do this maybe several times, not just once or twice, maybe 3 or 4 times, right? Because, I mean, look at this market here, right? Can you time all this right here? And look, timing the eventual top, the secular top, right? Which I really call secular is, a bull market that runs for a year, for 2, 3, 4 years potentially, right? That's a secular bull market, not one that just goes for a month or so, or 2 months, right? These are more medium term. And can there be anything done about it, right? So that's basically what we can always come back to. And we did do some pertinent research into this, and and it turns out that there is some work on the topic, among hedge fund managers and quant circles and institutional traders. And there appears to be some early signs, right? There's some work on when too much money chases the same hot stocks. It's all, of course, all the stock market research, is because crypto is so new, and this is a phenomenon that's referred to as momentum crashes, and that's, I think, is what we've seen here. Just imagine a bunch of people on a boat, right? There's a boat, and everyone suddenly, runs towards either the stern, right, or the bow. And what does the boat do? It starts tilting and starts sinking, and everyone just quickly on its back, and then it becomes balanced again, and potentially keeps on going. I don't know, it's not the best analogy, but it's the best one I could pull on my butt so quickly. But the name of the game here really is to recognize these types of momentum crashes, right? And most importantly, of course, differentiate them from regular crashes that lie on the onset of a real secular bear market, one like the one we saw in stocks in 2007, 2008, right? So, or in crypto, in 2018, or 10 years later. we're having a lot of fun. And so the main observation that appears to, exactly what we saw in crypto is that all of a sudden, all the lowest quality stocks, or in this case, of course, with crypto, it's coins, right? They're being selected by momentum systems. So momentum trading systems, which hone in on the type, on symbols that trade maybe a basket of stocks, or this, in our case, crypto. Right? They hone in on the lowest performers, and because they start punching higher, and they kind of really start jumping ahead, and they're being selected as the ones having the highest potential, right? And that's exactly what we saw just before things got really ugly, right? About 2 months ago. And, all these shite coins, right? That really nobody wanted to touch with a 10-foot pole just a week or two earlier, were being hyped and then start to kind of pull ahead of the game, right? Really, and went through the roof. And so our system, I remember 1 week it was making like, I think 60, 63 freaking percent in 1 freaking week, and we were holding these awful shitcoins like ETC, Ethereum Classic, or Doge, I think. So don't get started with Doge on me. Right? the takeaway message here really is in the context of what we do here with Cryptonaissance, with the system. Once we see the bottom feeders, right, of the crypto world, of the crypto space, being propelled to the top of the pack, then it might be time to pack up your bags and head for the exit. Right? So that's one observation. The second one is what researchers in hedge funds and institutional trading circles call Zscore. They're Zscore spikes actually. And actually, let me show you what I refer to, because I wrote a post on Zscore a while ago. When was that? 11 months ago. Okay, so Zscore, right? I'll provide an example here. From Burning Man, right? Because I talked to my buddy Tony. He's a quant trader, and he's always at Burning Man. Not last year, of course. And so basically, this is the formula. What you do, you arrive at the mean, right? You calculate the mean of a particular data set. And then you take a particular measurement, let's say the last one, right? And then you divide that, the product here, by the standard deviation. And that kind of gives you the score of it. Why? Because, see, by dividing it by the standard deviation, right, which is really like how far is it away from the mean, right? What is really the distance, right? 68% of the time, I don't know, maybe I have a pen tool here somewhere, but I forgot. I just set this up the other day. I forgot actually how to activate it. Never mind. When I just started with the mouse, see right here, you see this bell curve, right? And 68% of the time, I really apologize for not drawing this properly right here. But 68% of the time, that's one standard deviation. That's how far it usually should, extend, right? Price action or whatever measurement you might take. Corn production, who knows what. Within, expecting a certain amount, right, every year within one standard deviation at 68% of the time. So why do we do this? We divide this by the standard deviation because when I arrive, we want to be able to score it. We want to, where this this value that we measure, how does it fit in? And so by doing this, right, by using a Z-score, and you basically get a ranking. And if you, let's say, go back to what I'm talking about in crypto, if you see all these crap coins, start all spike higher, so having this huge spike, right, where they're really far, far away from their regular standard deviation in terms of performance. So when you see all these spikes popping up, right, it's kind of like the disturbance in the force, right? Something is going on, and that's probably time to start paying attention as well. The third observation that's being discussed in various pertinent papers is related to pairwise correlation, and especially pairwise correlation of the lowest quality coins. Now, imagine not just like ETC or Doge, right? Yeah, bite me. But the growing numbers of altcoins that really nobody in their right mind should be holding, and suddenly become all highly correlated. And, a correlation factor, for instance, of 1 would be positively correlated. and correlation factor of -1 would be negatively correlated. So meaning that, you know, it moves up, the other moves exactly the same amount down. I know that sounds kind of academic, so you know what? Let's go geeky a little bit. I've actually let's do something. Let me move myself here to the side. Okay, you go here, Mike, and then create a new. Let's say use the current one. All right. So I'm going to actually import some things here. Just bear with me here, okay? So we're gonna calculate a mean. We're gonna need that. We're gonna also need import standard deviation. Then we're gonna have to do some randomness. We're gonna create some random numbers, okay? Just stick with me. This is gonna be fun. Numpy random import RDN, and I think it's RA and the N, yeah. And then from numpy random, also we need a seed, right? Yeah, import the seed. And then we also want to be plotting something. Matplotlib import pyplot. Okay, let's see if nope, I misspelled that. Sorry, pardon me. Matplotlib. There you go. Okay, so the first thing we're going to do, we're going to create a seed. And that's it's just seeds a random number generator. Okay, it's just, don't worry about that. Now we're going to prepare our data. So let's say data 1, and now we're going to do let's say 20 by random, right? And then we're going to go 1000 and plus 100. Okay, and we're going to do, well, let's do a second one. Well, okay, data 2 equals okay, let's use data 1. Because we want to demonstrate a correlation, right? So and then 10 by random, again 1000, right? And then let's say plus 50, right? Okay, boom. So we have now data 1, and see that's like an array of 1000 values. If you go on len, we have 1000 values, right? And we have data 2. Okay. Cool, very nice. We could print the stuff while we're seeing it here. So let's do pyplot, okay? And we're going to scatter chart. The scatter chart just basically shows us exactly what we want to see. And we'll go data 1 and data 2. Boom. All right. So nice, right? So it's really nice in these notebooks, in Jupyter notebooks in Python. You can really show things very nicely. And very quickly, right? So basically what did we do here? We created 2 data sets, and obviously they're quite close to each other because, we're using data 1 as one of the components of data 2, right? It's one, and so the assumption is that it's fairly highly correlated. But how is it correlated, right? And that's kind of like, that's when the concept of covariance comes in, and that's how we really relate things to each other. And that's how we would do it. Like if I wanted to go, let's say, through a universe of crypto coins, right, and analyze their, let's say, the recent returns, right? We could go and just say, okay, analyze the recent returns, not the value, because they're all relative, right? Just say in terms of percentage points, what are the recent returns? And so what we could come up with is like a covariance method. Sorry, my email keeps blinking. I get too many emails. Don't email me. And so we could do something like covariance. And I made some notes here, so I don't know everything by heart. Okay, forgive me, guys. So yeah, basically, you can do a covariance by just using the covariance function. I think I need the covariance. Do I have that? I think it's numpy covariance, if I'm not mistaken. Yeah, I think so. Okay, from numpy import covariance. Let's do this first. Yeah, covariance. Yes. Okay, cool. You reuse this. Never mind. And then when I hit this and becomes a new line, it basically executes, right? That's how this works. And then let's do a covariance of data 1 and data 2. Okay, so this is going to give me a covariance matrix. it's going to give me a covariance matrix. Yeah, what does the hell does that mean? Yeah, honestly, this is very difficult to interpret, and that's where a lot of people are like, oh God, what the hell is he talking about, right? Okay, what does this number mean? Well, so you increase the numbers here, right? This is obviously a high number. It's a positive number, so we know it's a positive correlation. And since it's it's a pretty high number of 1,000 data sets, so the assumption is that it's got a pretty high correlation. But honestly, interpreting it is, I never look at this stuff like this. So what a great way of taking this, right, just the covariance matrix here, right, which is basically describes how close these two data sets are kind of related to each other, right? A good way of doing that is, for instance, using the Pearson's coefficient. And let's do it this way, and it'll make complete sense to you. Okay, check this out. Pearson's equals we already have the covariance. And all we need to do then is basically divide it by the standard deviation. Remember, I calculated the standard deviation before. I included before. Standard deviation of data 1. And then you are, dividing it by, multiplying it by standard deviation of data 2. And let's keep our fingers crossed. Divide it, yeah, bracket. Okay, oops. All right, I made a mistake here. Apologize. Okay, standard deviation. Nope, I don't see. Oh, right. Sorry about that. I have a, All right, so, okay, now what that gives us is this. And if you're still listening, that's the number, right? There's actually a call for that in Python, which is really awesome. You can just basically just call the Pearson's, it's called Pearson R or something, and you can, you just can get that number right there. You don't have to really look at the coefficient, right? The coefficient, the correlation matrix here. But basically these two numbers, that's it, 0.88. And that's obviously a high correlation. And that's really the call I would make, right? I mean, this is the code right here. If I would take two data sets, I would just basically calculate the performance of the data, of the returns in the past few weeks, right? Let's say pick a window, last 2 or 3 weeks, and you calculate the performance in that particular time frame, and then you compare what the performance is across the entire universe, but especially in the lower performing ones, right? So you grab all the coins, which I am doing, and then in both Bittrex and Binance and Kraken, maybe KuCoin, all this. So you pull all these out and looking at maybe a few thousand coins, and then see what are the lowest performers over the last, I don't know, 3 months, 6 months, and then you take from all those which have the lowest performers. Maybe this is like the last 20% or so, just for shits and giggles, and then you exactly use this calculation down here, right? This one here, and to analyze the returns of each of those. And when you see, that you get a pretty high correlation between all of them, all these data sets, right? Well, then you're in business, right? Because then you know that something's going on. All of them are A, they're highly correlated, and B, they're also highly performing, right? And that's something that can be done. It's something that can be done in code, right? And I can definitely write this, and I can come up with some kind of algo. Am I going to do that anytime soon? Maybe. We're working on stuff. I think we're gonna. What I don't want to do. See, when you develop this kind of systems and stuff, and when you try to improve on something or provide means to avoid pain. Okay, I think that's probably the best way to put it. If you provide means, if your goal is to avoid pain, usually, right, by avoiding losses, the human mind can jump through all kinds of hoops and come up with all kinds of great ideas. And what I used to do back in the days is just trying to kind of think out of the blue and relying on myself being smart or something, which was completely stupid because honestly I'm not that smart, compared with many people out there. So hopefully smarter than some, but we're all standing on the shoulders of giants. So we're looking at research material like such as this, and we're saying, great. Here's good material that we can use potentially to avoid pain in the future, and maybe come up with some kind of tool. But and then back in the days, what I would have done is just to sit down, write something, come up with some kind of alert mechanism, and then thought I was done. But in the real world, things usually don't work out this way. So the plan, I think, at this point would be to take a look at this, observe this, write some notebooks that maybe do some of the data sifting, which is not too difficult to do. I mean, you've seen this is pretty fairly trivial. You can wrap all this into a function, and then you can just pull all those coins out. I use CCXT for that, which is a pretty cool crypto API. And then I can do all this data mining, and Bob's your uncle. But a lot of times you are, kind of fooling yourself, and so I really need to observe, and I need to observe if things actually play out. And I wouldn't want you guys to kind of like rely on me in the context of something where I seem to make a lot of sense, because I can write a few lines of code, but then in reality things don't pan out the way we imagine. So I think we should look at all this. I think these are good ideas, and we're going to pursue that. And I just want to kind of pass that on. Maybe some of you guys have great ideas too. And as we kind of progress, and Scott is going to keep working on this as well, and so will I. We'll see. Maybe we can flag some alerts in the future. In the next few months. Hopefully, we're not going to get a big correction again anytime soon. Meaning in the next 3 to 6 months. But if we can see these kind of alerts, one of those three, either the crap coins bubbling to the surface and taking the lead, a lot of Zscore spikes, right? Like I described in terms of performance, and on top, high correlation between them in terms of returns, right? Pairwise correlation, as they call it. Well, it would be really a basket of correlation in this case, right? Then, and we see really a correction afterwards, which would not be unthinkable, because I see this kind of stuff in terms of implied volatility in the market all the time, right? We see these when implied volatility really dies down too much, a big spike is coming. It's kind of an inverse situation there, But it's there's references and there's correlations. That word again. Okay, I hope that makes sense. So what we're looking for is high correlation between all these, all this garbage floating to the surface, right, towards the end of a medium-term leg, and that would potentially be the harbinger of trouble on the horizon. Momentum crashes. Might be ahead, and it happens all the time in crypto, obviously. So I don't think it's going to be possible to build, a system that can really account for every wiggle in the market. Okay, I've tried for many years, and many people better than me have tried and failed as well. But what we can do perhaps is, provide advanced warning in certain cases when it becomes too egregious, right? When it becomes so clear, maybe our signal isn't flagging yet, the main signal, and we say, okay, maybe it's time to reduce exposure a little bit. Might help. Maybe go into USD or USDT, if you're trusting, Tether. Okay, so that's something we're going to be working on, and I'll keep you guys posted. So I'm going to stick my head together, a few smart people as well, and see what we came up with. I hope that was entertaining and not too boring, and see you next time.